Hi, my name is Dave Dejewski. I'm the owner and managing director of Transworld Business Advisors of Central Maryland, and I'd like to tell you a story about a business owner in his 80s. Now, this man loved his work. He had built something real. It took him several decades to do it. And for a long time, he could not imagine stepping away from his business. Now, a few years ago, he received an offer for about $1 million, and he didn't take that offer. It's not because the offer wasn't fair. It was at the time, based on his earnings, which I did have an opportunity to look at. And it wasn't because the buyer wasn't qualified. He was. The owner simply wasn't ready. And so fast forward a few years later, the market shifted during that time. His energy shifted and his focus began to wane. So what that looks like on a P&L and a balance sheet is it looks like softening revenue. It looks like margins are tightening, and his business began to decline. So by the time we got it just a couple of years later, we revalued his business based on current earnings, and it was worth just a little bit more than $200,000. So he had gone from $1 million opportunity to barely over $200,000. And that was the hard reality of his situation. And we showed him how it all worked in math, and he got it. But that wasn't the most difficult part of this story. So on the surface, a sale like this looked pretty straightforward. So it was a federal contracting business. He didn't go direct to government. He was direct to other federal contractors who were direct to government, and he had about 40 active contracts. Now, those contracts were primarily servicing other federal contractors. And even though we had our suspicions when we structured it this way, we originally planned for an asset sale. We were going to transfer the contracts, close the deal. Except during discovery, whenever you have contracts involved, you have to go and you need to look for things like change of control clauses. Now, change of control clauses are often found in contracts that protect the current customer from a change of ownership. So they don't want to contract with one group and then have that group change, like the bait and switch at the end of the day. Even if it's an indirect ownership change, clients have the right to terminate a relationship if they don't like the new party that comes in. So an asset sale would almost certainly trigger those change of ownership clauses. And so what appeared to be a clean asset sale in the beginning, it needed to be converted now to a stock sale. Not normally that big of a deal. Attorneys do this all the time, but that one decision changed everything for us. So when you change to a stock sale from an asset sale, it means that the buyer wasn't just purchasing assets at this point. The buyer is now stepping into the entity as the former owner, which meant that we had to go back and examine more than 30 years of corporate history. So we had to go through minutes and resolutions and stock issuances and officer elections and debt authorizations and guarantees. It actually became a full equity audit. And when you do an equity audit on a company that's operated for many decades, you're not going to find perfection. You're going to find gaps. You're going to find informal decisions that may not have been documented properly. You're going to find that debt has been layered over time. And in this particular case, we had found stocks that were issued to people that didn't exist anymore. It was difficult to find them. We had to bring all of that to resolution before we turned over a clean container. There was even legal issues that went back 12, 15 years, which were still lurking in the shadows and had threatened to cause problems in the future, which the new buyer would inherit at that time. So we also found debt. There was more debt in the deal than the purchase price could cover. And if you can let that sink in for a minute, even at a reduced valuation, it might sell, but the business couldn't generate enough proceeds to pay off what was owed. We weren't negotiating price anymore at this point. Now everything had switched over. We were trying to prevent collapse. The current business owner's home, private home, was at risk of being taken away. His family was in jeopardy of not having not only a provider in the family who was running the business anymore, but they were going to lose all their private assets. So this became a very significant issue. And it is at a stage like this that many transactions can just die. Because when proceeds are not going to cover debt, sellers are going to feel trapped, buyers are going to feel like they're taking on too much of a risk, and creditors want to be made whole. The buyers want a clean balance sheet. So in cases like these, stress increases and time compresses. And this wasn't just business stress that I'm talking about. This was the family home that was exposed in this case, and the creditors were circling. So the wrong outcome here could have meant losing not just the business, but personal assets. So we really had to get creative. We worked through cross-collateralization. We brought in additional assets. We worked with the buyer. We negotiated with lenders. We structured the transaction so that instead of cash at closing, the value in this transaction came in the form of debt relief. We also were able to negotiate an employment contract for the current owner because he really loved his work, as I said in the beginning, and he wanted to keep doing it. He just didn't feel that he was in a good position to continue ownership and management of it. So the sale transaction didn't put cash in the seller's pocket. It sold for several $100,000 in debt forgiveness. Now, on paper, some people might look at that and say that wasn't a win, but I can tell you when the alternative is losing your home and you're in your 80s, it absolutely is a win. He walked away clean. He kept his house. He protected his family. And I can't tell you how many times he reached out to me to tell me how grateful he was. He was genuinely relieved and grateful at that transaction. But we took a lot of twists and turns. It took some time to get this done. So there's several lessons here. And the first is obvious. Timing matters. When the multi-million dollar, or when the $1 million offer in this case came, the business was in a much stronger position. So the energy was higher overall. The revenue was healthier. Leverage was on his side. The market was on his side. Waiting cost him value. That's not just my judgment. That's the reality of the situation. The second lesson is less obvious. You don't know at the beginning of a sale process what the sale will become. We started with what looked like a simple asset sale. We ended up with a stock sale conversion, written client consents, 30-year equity audit, debt negotiations, cross-collateralization, and a debt relief structure instead of cash proceeds. And that's a very different transaction than what we started with. If he had tried to navigate that alone, it very likely would have collapsed. So if you operate it doesn't really matter what business you operate in. Change of control clauses are real. There are also several other risks that are embedded into different types of business structures that are not theoretical. They actually matter. They affect structure. They affect timing. They affect buyers' appetite. And you can't assume that things like your contracts are going to transfer just because you want them to. When the structure changes from asset to a stock, then due diligence is going to expand dramatically. Buyers are going to inherit everything in a stock sale, which means every historical decision, every legal potential action, it all becomes relevant. And that's why preparation matters long before you list a business. And that's why we spend time up front doing discovery and working with you to make sure that we turn over all the rocks and we see what kind of risks and what kind of structural issues we have here to deal with. Now, here's what I would like local business owners to hear. First, don't assume you're going to know when it's time to sell. Emotional readiness and market readiness are two different things. Second, understand your leverage window. Strong earnings create options. Declining earnings reduce them. If you're in a strong earning situation, your business is much more likely to attract a lender, for example. So when a buyer is going out looking for leverage to buy your business, they're much more likely to get a loan if you have strong earnings potential, you have an increase in earnings that can be tracked over years. If you're in decline, a lot of lenders will not finance as much. Third, surround yourself with experienced advisors early. Don't wait until you're in a crisis, and don't wait until creditors are pressing or until your revenues go into decline. If they are in decline, there's a lot of things that we can do to help still package and sell that business for a reasonable and an attractive price, particularly if there's extenuating circumstances going on. But don't wait, because when unexpected twists appear, and they always do, you need people who can think structurally, legally, and financially under pressure. It's the difference between losing everything and walking away clean, and that often comes down to who's in the room with you. So this story didn't end with a retirement party and a large wire transfer. It ended instead with relief and gratitude from the business owner. And sometimes that kind of relief is the real victory. So if you own a business and you're in 50s, 60s, 70s, or even younger, and you're thinking about selling, you're thinking selling might be in your future, don't wait until decline forces your hand. Explore your options while you still have leverage, because business sales rarely follow a straight line. They're going to twist. We're going to uncover history. They're going to test structure. And you don't want to face those twists and turns alone. If you'd like to have a confidential conversation about where your business is today, even if selling is years away, then that's a conversation worth having, not because you're ready to exit today, but because preparation protects you from surprises. Just reach out to us and let us know you'd like to chat, and we'd be happy to get you on the calendar, and we'll have a free consult with you about where you are and what kind of issues you'd like to talk about. Thanks for your time today, and I look forward to seeing you when it's your time for a significant transaction like the sale of your business.